You know that feeling when you look at your bank account and it just doesn't seem to grow no matter how hard you try? That frustrating feeling of being stuck in a financial rut. Well, you're not alone. Growing your wealth is a journey that many aspire to embark on, but the road to riches can be long and winding. Why is it that the first $100,000 is so darn difficult to reach? It's a question that plagues countless people who dream of financial freedom, but feel like they're constantly spinning their wheels. Maybe you've been there too, working hard, trying to save, but never quite seeming to make any real progress. Well, hold on to your hats, because we're about to dive deep into why that first $100,000 is such a monumental hurdle, and more importantly, why the next $100,000 becomes a whole lot easier. Now, you might be thinking, but I'm not even close to having $100,000 saved up. And that's okay, because we're going to cover practical strategies for getting there, no matter where you're starting from. So, whether you're fresh out of college with student loans weighing you down, or you're a seasoned professional who's struggling to build up your savings, this video is for you. Welcome to MoneyWise Investor, your trusted source for financial information. All right, let's start with the wise words of Charlie Munger himself. This billionaire investor hit the nail on the head when he said, "The first $100,000 is a bitch." Now, you might be thinking, whoa, language. But Munger's blunt statement gets to the heart of the matter. That first $100,000 is tough to accumulate. And there are a few key reasons why. First up, let's talk about the psychological barriers we face when it comes to investing. For a lot of folks, the idea of putting their hard-earned cash into the stock market or other investments is downright terrifying. We've all heard horror stories about people losing their life savings, and that fear can be paralyzing. But here's the thing, not investing can be just as risky, if not riskier than investing itself. Inflation is a sneaky little monster that is constantly chipping away at the value of your money. If you're not investing and growing your wealth, you're essentially losing money every single year. Another big hurdle is the misconception that you need a ton of money to even start investing. But that's just not true. Thanks to the wonders of technology and platforms like Robinhood and Acorns, you can start investing with just a few bucks. Of course, the amount you invest matters. The less you start with, the slower your money will grow. And that leads us to the next big question, why that first $100,000 is so tough. Compound interest. Compound interest is seriously powerful stuff. It's the reason why Albert Einstein called it the eighth wonder of the world. But when you're just starting with a small amount of money, growth through compound interest will be too slow. Let's say you have $10,000 invested, and it grows at a rate of 7% per year. After the first year, you'll have $10,700. Not too shabby, right? But in the second year, you're earning interest on that initial $10,000 plus the $700 you earned in the first year. It's a slow build. But once you hit that $100,000 mark, that's when things start to take off. Suddenly, you're earning interest on a much higher base amount, and that interest starts compounding at a faster and faster rate. It's like a snowball rolling downhill, gaining more and more momentum. So, in a nutshell, the psychological barriers, misconceptions about needing a ton of money to start, and the slow build of compound interest when you're just starting are what make the first $100,000 such a beast to conquer. But don't despair. We're going to dive into some strategies for climbing that mountain a little later. For now, let's talk about just how long it might take you to reach that elusive first $100,000. And that all depends on a few key factors: your income, your savings rate, and the rate of return on your investments. Let's start with income. The more money you're bringing in, the easier it'll be to sock away cash for investments. But even if you're not exactly rolling in dough, don't count yourself out just yet. Say you're making the median household income in the US, which is around $67,000 per year. If you're able to save 10% of your income, which admittedly can be tough for a lot of folks, and invest that money in a relatively modest 6% annual return, it would take you about 27 years to hit that $100,000 mark. Now, you might be thinking, 27 years? I'll be old and gray by then. And you're right. That's a long time to wait for that first big milestone. But don't worry. There are other ways to speed things up. If you can bump up your savings rate to 20% of your income, suddenly we're looking at just 18 years to reach $100,000. And if you can find a way to increase your income, whether it's through a job change, a side hustle, or just some good old-fashioned hustling, the timeline gets even shorter. Let's say you're able to boost your annual income to $100,000 and save 20% of that. At a 6% return, you'd hit $100,000 in just 11 years. Not bad, right? Of course, these are just examples, and your situation might look a little different. But the point is, the more you can save, and the higher your rate of return, the faster you'll be able to cross that $100,000 finish line. And speaking of rates of return, that's another key factor to consider. If you're just stashing your cash in a savings account, you're probably only earning a measly 0.5% or so in interest. Not exactly the kind of growth that's going to get you $100,000 anytime soon. That's why investing, whether it's in the stock market, real estate, or other assets, is so important. Sure, there's more risk involved, but there's also the potential for much higher returns. And those higher returns can seriously accelerate your wealth-building journey. Let's look at an example. Say you're able to earn an 8% annual return on your investments instead of that 6% you've been using. Suddenly, that $100,000 milestone is within reach in just 16 years. If you're saving 10% of a $67,000 income, bump up your savings rate to 20%, and you're looking at less than 11 years to hit $100,000. Of course, earning those higher returns isn't just a matter of throwing your money into the stock market and hoping for the best. It takes research, discipline, and a solid investment strategy. But it's doable, and it can make a huge difference in how quickly you reach your financial goals. Well, this is where things start to get interesting. You see, that first $100,000 was just the beginning. It was the foundation, the launch pad, if you will. But now that you've got that solid base, it's time to start building something truly spectacular. The first thing you'll want to do is to take a step back and reevaluate your financial goals. Sure, $100,000 is a nice chunk of change, but chances are it's not enough to fund your entire retirement or achieve all of your financial dreams. So what's next? One option is to keep that money invested and let compound interest work its magic over the long haul. Remember how we talked about the power of compounding earlier? Well, now that you've got a solid base, that snowball effect is going to start picking up steam. Let's say you have that $100,000 invested and earn an average annual return of 8%. In 20 years, it'll have grown to over $466,000. In 30 years, a cool $1.1 million. And that's without adding another penny to your investments. Of course, the smarter play is to keep contributing to your portfolio as you're able. Even just setting aside an extra $500 per month could turn that $100,000 into over $1.2 million in 30 years, assuming that same 8% return. But investing for the long term isn't the only game in town. Once you hit that $100,000 milestone, you might also want to start thinking about diversifying your investments. You've probably heard the old saying, don't put all of your eggs in one basket. Well, that's solid advice when it comes to investing too. Sure, you might have gotten $100,000 by putting everything into stocks or mutual funds, but as soon as you start accumulating more wealth, it's a good idea to spread things out a bit. Find a mix of investments that align with your risk tolerance and financial goals. That way, if one area of your portfolio takes a hit, you've got other investments to help cushion the blow. Speaking of risk tolerance, that's another thing to reevaluate once you've crossed that $100,000 threshold. When you're just starting out with a smaller nest egg, you might be able to afford to take on a bit more risk in pursuit of higher returns. But as your portfolio grows, you'll likely want to start dialing back that risk a bit. After all, you don't want to jeopardize all the hard work you've put in to get to this point. The bottom line is that once you've hit that first major milestone, it's important to take a step back and make sure your investment strategy still aligns with your goals and risk tolerance. What got you to $100,000 might not be the same approach that'll get you to the $500,000 or $1 million mark. So, what are you waiting for? It's time to get out there and start chipping away at that first $100,000. And if you ever feel like you're losing steam or motivation, just remember that the next $100,000 is going to be a whole lot easier. If you found value in this video and want to continue leveling up your financial game, be sure to like and subscribe. And if you've got any other money-burning questions, drop them in the comments below. We're always happy to help fellow wealth builders like yourselves. Thanks for watching, and until next time, stay money-wise.